Preparing for a financial analyst at Windstream interview? You've reached Candy Mentor, and this video is for you. We'll walk through 20 key questions you're likely to face. For each question you'll see a sample answer followed by the key points to cover. Subscribe, like, and share, and drop a topic request in the comments. Question 1. Walk me through your background and explain why you want to join Windstream as a financial analyst. My background combines financial analysis, Excel modeling, and business partnering. I enjoy turning operating data into clear recommendations, and Windstream appeals to me because telecommunications requires both recurring revenue analysis and careful infrastructure investment decisions. In prior work, I built forecasts, investigated variances, and presented conclusions to non-finance stakeholders. I would bring that same disciplined approach here, while learning the company's network economics, customer trends, cost structure, and capital priorities. While answering, connect your analytical training, financial modeling experience, interest in telecommunications, and motivation to support a network-intensive business through disciplined forecasting, performance reporting, and commercially useful insights. Question 2. What financial metrics would you monitor most closely for a telecommunications company like Windstream? I would monitor revenue by product and customer type, subscriber additions, churn, average revenue per user, adjusted EBITDA, operating cash flow, capital expenditures, and leverage. I would also track network reliability and installation economics because service quality can influence retention and costs. The key is connecting leading indicators to financial results. Rising churn may pressure revenue later, while higher fiber penetration could require near-term capital but improve retention, pricing, and long-term cash generation. Make sure to cover revenue growth, subscriber and customer trends, churn, average revenue per user, adjusted EBITDA, cash flow, capital expenditures, leverage, service reliability, and how operational metrics translate into financial outcomes. Question 3. How would you build a monthly operating forecast for Windstream? I would begin with historical actuals and identify the primary drivers for each revenue and expense line. Revenue might be forecast by customers, churn, pricing, and product mix, while costs could reflect headcount, vendor contracts, network usage, and maintenance activity. I would incorporate approved initiatives and known one-time items, then review assumptions with operating leaders. Finally, I would compare results with the prior forecast, explain variances, and update the model transparently. In your answer, talk about establishing historical baselines, gathering business driver assumptions, separating recurring and one-time items, modeling revenue and expenses, validating with stakeholders, and documenting forecast versus actual changes. Question 4. Explain the difference between EBITDA, EBIT, and free cash flow. EBITDA is earnings before interest, taxes, depreciation, and amortization, so it highlights operating performance before non-cash asset charges and financing effects. EBIT includes depreciation and amortization, making it closer to operating profit after using the asset base. Free cash flow starts with operating cash flow and subtracts capital expenditures, reflecting cash available for debt reduction, investment, or other uses. For a telecom company, that distinction matters because network investment can be substantial. Be sure to mention the calculation logic, depreciation and amortization, capital expenditures, working capital, interest and taxes, and why analysts use EBITDA while investors ultimately care about sustainable cash generation. Question 5. How would you analyze a significant unfavorable variance in monthly results? I would first validate the source data and quantify the variance against budget, prior forecast, and prior year. Then I would decompose it into volume, price, mix, timing, rate, and one-time effects. For example, a revenue shortfall could reflect higher churn, delayed installations, or an accounting timing issue. I would speak with the responsible teams, determine whether the issue is temporary or structural, revise the forecast, and clearly communicate actions and risks. Focus on quantifying the variance, separating price, volume, mix, timing, and classification effects, confirming data accuracy, speaking with owners, identifying root causes, and recommending corrective actions with an updated outlook. Question 6. What is a three-statement financial model, and how do the statements connect? A three-statement model links the income statement, balance sheet, and cash flow statement into one operating view. Net income flows into retained earnings and starts the cash flow statement. Depreciation reduces earnings but is added back in cash flow, while capital expenditures increase assets and reduce cash. Working capital movements also affect cash, and debt balances connect financing activity with interest expense. I always include a balance check to catch linkage errors. Make sure to cover the income statement, balance sheet, and cash flow statement, retained earnings, non-cash expenses, working capital, debt, capital expenditures, and the importance of balance sheet checks. Question 7. How would you assess whether a proposed network investment is financially attractive? I would compare the investment's incremental cash flows with its upfront capital requirement. Those cash flows could include new customers, higher pricing, lower maintenance, reduced churn, and operating savings. I would calculate payback, NPV, and IRR using an appropriate discount rate, then test adoption, pricing, construction cost, timing, and useful life assumptions. I would also consider reliability and strategic coverage benefits, while clearly separating measurable returns from less certain qualitative advantages. Discuss incremental revenue, avoided costs, operating expenses, capital spending, customer retention, useful life, payback, NPV, IRR, sensitivity analysis, execution risk, and strategic benefits that may not appear immediately in reported earnings. Question 8. What is working capital, and how could it affect Windstream's cash flow? Working capital represents short-term operating assets and liabilities, commonly including receivables, payables, inventory, and certain deferred balances. If receivables rise faster than revenue, cash is tied up until customers pay. Longer vendor terms can preserve cash, while building inventory consumes it. Deferred revenue may provide cash before service delivery. I would analyze balances relative to revenue and activity, investigate unusual movements, and distinguish timing effects from genuine deterioration in collections or vendor management. In your answer, explain receivables, payables, deferred revenue, inventory, billing timing, collections, vendor terms, and why an increase or decrease in each operating balance can have different cash flow implications. Question 9. How would you forecast revenue for broadband or other connectivity services? I would build revenue from operating drivers rather than applying a simple growth percentage. The model would begin with opening customers, add gross additions, subtract churn, and apply pricing and product mix assumptions to the average customer base. I would separately consider installation timing, upgrades, promotional pricing, and seasonal patterns. Then I would reconcile the driver-based result to the general ledger and investigate differences, ensuring commercial assumptions are consistent with sales and operations plans. Cover customer starting balances, gross additions, churn, net additions, pricing, product mix, installation timing, penetration, upgrades, seasonality, and reconciliation of operational drivers to reported revenue. Question 10. What is churn, and why is it important in a telecom financial analysis? Churn measures the rate at which customers or revenue leave during a period. It matters because lost customers reduce the revenue base and can make acquisition spending less productive. I would examine churn by product, geography, tenure, customer type, and reason, then compare it with pricing and service quality data. A lower churn rate can improve customer lifetime value, reduce replacement acquisition costs, and support more predictable cash flow, even before significant price increases occur. Be sure to define churn, distinguish customer and revenue churn, explain its effect on lifetime value and acquisition economics, identify drivers, and describe how retention improvements can influence revenue, margins, and capital efficiency. Question 11. How would you evaluate a cost reduction initiative without damaging service quality? I would establish the current cost baseline and identify whether savings come from procurement, process changes, staffing, technology, or reduced activity. Next, I would estimate implementation costs and timing, then test potential effects on outages, installation delays, customer complaints, and churn. I would assign accountable owners and track realized savings against the approved business case. A strong initiative reduces structural cost while preserving service reliability, rather than simply postponing spending into a later period. Focus on defining the baseline, separating sustainable savings from timing benefits, considering customer and network impacts, assigning owners, tracking implementation, and using operational service metrics alongside financial results. Question 12. Describe how you would build a budget and present it to senior management. I would translate strategic priorities into measurable revenue, expense, capital, and cash flow assumptions. I would collect bottom-up inputs from operating teams, challenge inconsistencies, and reconcile them with top-down targets. After building a base case, I would include downside and upside scenarios, emphasizing the assumptions that matter most. In the presentation, I would focus on decision-relevant trends, risks, and required actions, supported by concise charts and a clear bridge from prior year to budget. Mention strategic objectives, bottom-up operating assumptions, top-down constraints, scenario planning, ownership, reconciliation, key risks, concise visuals, and recommendations rather than simply presenting a collection of spreadsheets. Question 13. How would you use Excel to analyze a large financial dataset? I would first understand the data definitions, remove duplicates, standardize dates and categories, and validate totals against a trusted source. I would use structured tables, pivot tables, SUMIFs, XLOOKUP, and controlled assumptions to analyze trends and exceptions. For recurring work, I would create refreshable templates rather than manually editing outputs. I would also document key logic, protect formulas where appropriate, and perform reasonableness checks before sharing conclusions with stakeholders. Talk about data cleaning, consistent definitions, structured tables, formulas, pivot tables, lookups, exception checks, scenario controls, version discipline, and avoiding fragile models that cannot be reviewed or refreshed. Question 14. Tell me about a time you found an error in a financial report or model. In one reporting cycle, I noticed an expense trend that did not match operational activity. I traced the issue to a duplicated vendor import caused by overlapping date filters. I reconciled the corrected total to the general ledger, quantified the reporting impact, and informed my manager before distribution. I then added a duplicate record check and a control total to the process. The experience reinforced that analytical judgment includes validating outputs, not just producing them quickly. In your answer, use a clear situation action result structure, explain how you detected the error, quantify its effect, describe the correction, and show how you improved the process to prevent recurrence. Question 15. How would you explain a complex financial result to a non-finance manager? I would lead with the business conclusion, then explain the 2 or 3 drivers that matter most. For example, instead of saying margin declined because of unfavorable mix, I would explain that lower value customers represented a larger share of additions and reduced revenue per connection. I would quantify the impact, distinguish temporary from structural factors, and use a simple bridge or chart. I would finish by clarifying the decision required and confirming the manager's questions. Emphasize starting with the conclusion, using plain language, connecting financial outcomes to operational drivers, quantifying impact, avoiding unnecessary jargon, checking understanding, and ending with practical decisions or next steps. Question 16. What would you do if an operating leader disagreed with your forecast assumptions? I would first understand the leader's operational evidence and clarify exactly which assumption differs. Then I would compare both views with historical results, current pipeline data, customer trends, and documented initiatives. If uncertainty remains, I would present a base case plus sensitivities rather than forcing false precision. I would document the agreed assumption, owner, and review date. My objective is not to win an argument, it is to produce a forecast that management can understand and act upon. Cover listening first, testing assumptions against evidence, separating facts from judgment, using alternative scenarios, maintaining accountability, documenting decisions, and preserving a constructive partnership rather than treating the disagreement as a personal conflict. Question 17. How do rising interest rates affect a leveraged telecommunications company's financial analysis? Higher rates can increase interest expense on floating rate debt and make refinancing more expensive. That reduces free cash flow, potentially limits capital investment, and can pressure leverage or covenant headroom. I would model rate sensitivities, debt maturities, fixed versus floating exposure, hedging, and available liquidity. I would also consider valuation, since higher discount rates can reduce enterprise value. The analysis should distinguish a temporary earnings impact from a lasting change in financing capacity or balance sheet risk. Discuss floating rate debt, refinancing risk, interest expense, cash flow, valuation, covenant headroom, investment capacity, hedging, and the need to distinguish accounting earnings effects from broader liquidity consequences. Question 18. What financial risks are especially relevant to Windstream's business model? I would prioritize risks that could affect recurring revenue, cash generation, or network availability. These include customer churn, competitive pricing, outages, technology changes, construction overruns, vendor concentration, labor costs, regulatory developments, leverage, and liquidity. I would assess each risk by likelihood, financial magnitude, speed of impact, and management's mitigation options. For example, an outage can create immediate service costs and reputational damage, while technology obsolescence may require larger, longer-term capital commitments. Mention customer churn, competition, technology obsolescence, network outages, capital intensity, vendor dependence, labor costs, regulatory factors, leverage, liquidity, and execution risk, while prioritizing risks by probability and financial impact. Question 19. How would you approach a scenario analysis for a downside case? I would define a specific business narrative, such as higher churn, slower customer additions, pricing pressure, and delayed construction. I would translate those conditions into linked assumptions rather than applying an unexplained blanket reduction. Then I would model revenue, EBITDA, capital spending, working capital, cash flow, leverage, and liquidity effects. I would show the major sensitivities, identify trigger points, and pair the downside with practical mitigations, such as deferring discretionary capital or accelerating retention initiatives. Be sure to define the scenario, identify linked assumptions, avoid arbitrary percentage changes, model operational and financial consequences, assess liquidity and covenant effects, and present mitigations alongside the downside estimate. Question 20. Why should we hire you for this financial analyst role? You should hire me because I combine strong financial fundamentals with a practical, collaborative working style. I can build and audit models, investigate variances, and communicate conclusions clearly to both finance and operating teams. I am detail-oriented, but I stay focused on the business question behind the numbers. I also learn quickly and take ownership of deadlines. At Windstream, I would aim to make forecasts more reliable and help leaders allocate capital and resources intelligently. In your answer, combine technical skills, attention to detail, communication, ownership, commercial curiosity, adaptability, and evidence that you can turn analysis into decisions that improve forecasting quality and business performance. If you are still with us, congratulations, you are much ahead of the rest and serious about preparing for your interview. We hope we were able to add value to your preparation and create some helpful content. Do not forget to like and share this video. Your small act can do great things for us.